Welcome to the daily update, where I'll go over the action in the market for Wednesday, November 15th, and then we'll see how things look for Thursday, November 16th. We had an up day, wasn't really strong. The market's looking a little bit exhausted right now. We're still looking overextended to the upside in the short and intermediate term, but we are seeing some improvements in the longer term, and I have some charts to show you of that. So for right now, we're hanging in there. So let's go back and talk about what happened. Right at the open, we had a higher open and prices climbed above R1 at 45.17. Then we fell back down to the unchanged level, which on an up day quite often acts as support, and that's exactly what happened. We were able to stay positive with prices, but we didn't get back up to R1 before we closed slightly positive on the day. We were up 0.16% on above average volume. We've seen volume really picking up, and that is a good thing, especially when we're going higher. The technicals are still positive, but overextended in the short and intermediate term. We're showing some improvement in the long term. It continues to be about inflation, interest rates, growth concerns, earnings reports that are released. Geopolitically, it's still about what's going on in Israel. Then some comments that we can make. The S&P did close slightly above 4,500. I know the financial media loves these round numbers like this, and psychologically they do something too. Plus, if you trade in the options market, this is a pretty big strike price, but technically it really isn't all that important, but it's just something that we can latch on to. There's also potentially this thing called FOMO going on, and this is the fear of missing out. You had a lot of people just 2 weeks ago that were really negative on the market because we were really going down, and now we've shifted and we're starting to go back up. You have people that were sitting on the sidelines and they're like, oh my gosh, the market's really been going up, I better jump in. That's more of an emotional decision rather than any kind of logical decision. And sometimes that can slow things down, if not actually bring in a reversal, because a lot of times the people that use emotions in the market, they tend to get to the party late, just about the time it's over. So be careful of that. And it's something that everybody has to deal with all the time. President Biden and President Xi are meeting in San Francisco at the APEC summit. Of course, we'll probably need the White House to do some translating, not for President Xi, but to try to figure out what President Biden says. Oil ended up closing down at 76.56, not really in the picture right now as far as being really important. Our short-term list, it's still pretty long here. We have the 20-period exponential moving average, the Stochk RSI, the Williams percent R, the CCI 14 and 20, the force index, the stochastics, the RSI based on 9 periods, the boom indicator, and I've added the slope oscillator. Now, we use that more for momentum, but it's starting to get to kind of a high reading, and I'll show you that chart. Intermediate term, we also have some extreme positive indicators, the CMB composite, PMO studies, and rate of change 10. Those have been on the list for a while. A new addition is the money flow index. We don't get a lot of signals out of that one. And I've also added the vortex here because the green line's getting kind of high there. The TTM squeeze, and then we have the NASDAQ bullish percent index is starting to get extreme. Now, you can take these two ways. One is that we're exhausted and then we may be due for a pullback. Another way to look at this is showing that there's good momentum in the short and intermediate term. The current scenario that we're working with is not so much as the economy stronger than expected. It's that we're kind of in that sweet spot as far as the stock market is concerned right now. And the economic reports coming out are justifying things where they're at economically. But if we still continue to tip too far below and start to show some economic weakness, then the market will turn around and start to fixate on that. And that's when bad news could potentially become bad news. We know that the Fed is keeping rates higher for longer. They're not even talking about rate cuts right now. And they think that maybe they're even done raising rates at this point. Of course, we're keeping an eye on Israel, oil, and then earnings as they are released. The dollar was up and interest rates were also up. Both of these together could have produced some headwinds for stocks. The 10 to the 2 and the 10 to the 3 month are still inverted. We're still waiting for those to go back to looking normal, but we're not there yet. Sentiment is still at neutral, where we ticked up from 47 after Tuesday. We're at 53 after Wednesday. Our trend is still positive. This hasn't changed. We have the ADX going above its moving average, and both are above 20. That suggests a strengthening trending environment, and the green line's on top, so it is positive. our bias and momentum continued to be positive. The economic reports that came out, we had the weekly MBA mortgage applications index. It was up 2.8%. Last week, it was up 2.5%. Retail sales came in stronger than expected. They were still down at minus 0.1%, but they had expected them to come in down 0.3%. Last time they were up 0.9%. When you take out autos, we were up 0.1%. They had expected it to fall 0.2%. Last time it was up 0.8%. PPI came out. This was a biggie. It was down 0.5%. They expected it to be up 0.1%. The market liked that. Last time it came in up 0.4%. The core PPI came in unchanged. That was lower than the 0.3% increase they had expected. Last time it came in up 0.2%. The Empire State Manufacturing, they expected it to come in at -5. It actually came in at plus 9.1. Last time it came in at minus 4.6. Business inventories came in as expected, being up 0.4%, which is the same reading that we had last time. So here are some charts showing how the mortgage applications are seeing a bit of an increase week over week. Here's the retail sales where we're flattening out here. We're still above zero. So it's showing that a large part of the U.S. economy is still hanging in there for right now. We look at retail sales month over month where we did see a bit of a decline. Then looking at PPI, where the blue line is actually showing a decrease. This is the headline number, and then the core is actually starting to show a bit of a decline as well. And then when you look at final demand year over year, the blue line based on goods is going down, and we're flat to slightly declining with the services. Intermediate goods, the processed goods are the blue line, and they pretty much have flattened out, where the unprocessed goods, that's the gold line, that is showing an increase. And then the Empire State Manufacturing Index, it actually surprised by coming in at 9.1. And business inventories were unchanged from the previous month and still showing a bit of an increase. We're still at the 4.54%. We ticked up a bit with the 10-year yield. We're above the 4.02% level, which could bite into corporate earnings. Looking at the intraday chart where we had a higher open, we made it up to R1, and then we came all the way back down to the unchanged level. We bounced up off of that and treaded sideways and then closed just slightly positive. Here's the intraday chart where we saw a little bit of weakness after the economic reports were released. That's the blue area. The yellow area here is the cash market, and we're pretty much flat to slightly higher in the initial overnight session. And we look at growth to value, where we did see a decline with growth and value, but they were both positive overall. But this is a little bit of a concern. When we were having some problems in the market, we saw the growth to value ratio intraday really going up when you look at it for the S&P. Now that we've been seeing some strength, we're seeing this start to trail off. It would be more healthy if we would see this continue to go as price goes up, but this might be folks locking in some profits. Some end of day charts where we look at value to growth, where for the large caps, growth was up, but it underperformed. It also was up for the mid caps and underperformed, and it was actually negative for the small caps. The end of day chart, we're showing a little bit of an improvement with the S&P growth to value ratio. We want to see this continue to go up to maintain more of a positive posture. But this is looking a little bit better. We're rolling over a little bit with this growth to value ratio, but we're starting to break out and seeing just a little bit of weakness right now. Looking at small cap growth to value, where it really came down. And that's not a good sign. We're pretty much chopping sideways here in this range. We're still in a longer term uptrend, but we want to see this continue to go up. And if you look at the chart, and I'll point this out later, you notice that we had a pretty wide bar here, but then we closed almost at the bottom. Not at the bottom, but close to the bottom. That's usually not a good sign. And we're seeing kind of that same thing with the mid caps. They closed well off of the highs. The growth to value ratio is holding up a little bit better, but we did turn down slightly. Here's the condition of our trend. We're crossing back above the moving average and we're above 20. So that is a trending environment. The green line is on top and advancing. So that's a positive trend. Seeing pretty much that same thing with the short-term chart. Looking at volume, my goodness, I couldn't say that for a second here. We are seeing a pickup here, but we had been dropping off. This is now starting to come back up. Keeping an eye on sentiment, we're wondering if we're in this declining part of the VIX, where it usually on an average basis from 1990 to 2022 typically will decline throughout the month of November. Now, we go clear down about to here before we get to December. So it's not a straight shot by any means. There are times of bumpiness, and when we go back up, that usually means stocks are declining. Then we look at the Ulcer Index. This is a fear gauge that we follow, and we're trying to measure sentiment here. When we're getting really high readings from this, that means everybody is really freaked out right now, and a lot of times that will mark a market bottom. When we get a really low reading, that means everybody's complacent and they're just assuming things will go higher. And that applies to all of our different sentiment indexes, whether it's the Ulcer Index, the VIX, the equity put call ratio, and so forth. So this is showing that fear continues to drop off. Then when we do look at the VIX, we're pretty much flat with the line chart, and we're showing more of a decline here with the bar chart, even though we closed pretty much flat on the day. We're seeing just a little bit of a tick up with volatility when we look at the VIX of the VIX. And this tries to measure how fast is the VIX actually moving. So when this kicks into gear, then right after that, or about at the same time, then we tend to see the VIX really start to move. Here is the VIX to VVIX ratio, which it is starting to turn down, which could be longer term positive. And then the VIX to the 3-month average of the VIX, it's also starting to come down, which could be positive. The VIX to move ratio, the volatility of bonds versus the volatility of stocks, and it shows that stocks bounced back up just a little bit, but the volatility of stocks has been decreasing when compared to bonds. Here's the equity put call ratio, which after the weekend, folks were taking off some of these hedging positions. They might have even seen some profits with the lower open that we had on Monday, but this is really starting to come down now, and that could help things. When this is going down, that usually happens when the market's going up. So finally, our 5-period simple moving average is starting to come back down. It spiked up here and now is starting to drop, and that could be positive. And here's a long-term look at that same chart. Other times when we spiked, again, it doesn't mean that we're going to go straight from here, but this is one of these extreme readings. Now, if we really start to go down and have a big down day, this is going to spike back up. But the fact that it's starting to decline is positive. But longer term, we haven't rolled over yet. The 253-period simple moving average is continuing to go higher. It's trying to roll over, but it's going to take a while for that to happen. This fear gauge ticked up just a little bit, but it has been declining. And then this other fear gauge has also been declining. And so as these charts are going down, that means that people are more confident in the market. And we're seeing sentiment coming back up where it had been negative. Now it is back to neutral. And of course, right after this, it would have to turn more positive if we continue to go up from here. Looking at the risk on, risk off, this is also another sentiment gauge. When folks are feeling more comfortable about stocks, we see this ratio going up. When they're not feeling comfortable with stocks, they're actually preferring to get into bonds. That's when this ratio goes down. Longer term, this has been declining, but the last few days we've been seeing this coming back up. Can that continue to show some improvement, which again suggests that sentiment is turning more positive? Advanced decline line studies. Looking a little bit better here based on price, and we're above the moving average. We're coming right back up to the moving average based on volume. So when we look at the new highs versus the new lows, yeah, we fell back with the new highs, but we're seeing almost no new lows right now. So that's driving our 5-period and our 10-period higher. That's suggesting under the surface strength in the S&P 500. The advanced decline ratio continues to show improvement and is above 0. That's positive. Accumulation distribution ticked down just a little bit here, but we're still above the advancing moving average. The chicken money flow is showing a bit of an improvement here, and the red line is continuing to go up. That shows the smart money is still potentially buying. Then when we look at the cumulative NYSE advanced decline line, we're still seeing some improvement here. I should probably extend this trend line out. We might be coming right up to this level here, and our regular NYSE advanced decline line is starting to break above this trend line. Our other advanced decline line study for the NYSE, we're trying to come back above the 50-period moving average, but we are working off of a recent death cross here. That means that the trend of the NYSE is down. We want this to turn back up for it to be more positive. Then looking at our advanced decline line studies, breaking a little bit above the moving average with the NYSE common stock, showing some improvement with the S&P, the mid caps. The small caps are improving, but they're still underneath their moving average. Some short-term charts where we're coming right up to this pivot point. That was just about at the high that was set here. And we have this huge gap here from Monday to Tuesday. And then we'll see, is the market going to come back and try to fill that gap, or are we going to be able to break and go higher from here? Down on the bottom, we've had another day of above average volume. The 20-period exponential moving average is looking extreme positive, but we're still positive with the 50 and 200. The Stochk RSI is extreme positive. The Williams percent R is extreme positive. The CCI 14 and the CCI 20. Now, these can stay here for a while. It doesn't necessarily mean we're going to turn and go the other way. We just want to see that what is the general environment like? Is this more of a momentum play where we could still go higher from here, or is the market looking exhausted at this point? What does that mean? Are we going to chop sideways, or are we going to see some kind of a pullback? Then looking at the force index, it's still extreme. Even though it came down a bit, it's still just about at the Keltner band here. The stochastics are still extreme positive with all three short-term time frames. And we're still at the +3 standard deviation on this chart. So that's suggesting that we have gone up pretty far, pretty fast. We're still extreme with the 10-period rate of change, even though it did come down slightly. Now our intermediate term charts. The balance of power is really showing some strength here and could be getting close to being extreme. The CMB composite, even though it ticked down, is still above this black line that I put on here. So there's nothing magical about that. The go, no-go system is the dark blue, and that's more positive. And the blue line for the highest high value is now starting to catch up with price, and the midpoint is also going up. That is positive. The TTM squeeze is starting to look extreme positive on the daily chart here. Again, I put this black line in here, and it's right at about 150. So it's just a reference point. And then longer term, this is where I come up with this black line. I just look at the long-term chart, and then I say, okay, this looks like a good spot where things started to get extreme before they turned and started to go back down. So that's where the black line basically comes from. The ease of movement based on 14 periods is still positive and well above zero. The Arun is still looking more positive. We're above zero with the oscillator. And we're starting to get extreme positive with the S&P McClellan oscillator. So the summation index based on price is showing improvement, but still below zero. Based on volume, we're above zero and advancing. That's positive. The NYSE McClellan oscillator actually ticked down just a little bit, but it's above zero, so that's positive. So when we look at the NYSE summation index based on price, we're continuing to advance as well as volume. This is also a shift that we saw after Tuesday's session. We're finally seeing the Swenlin trading oscillator turn back up here, where it had been going down as the market was chopping sideways. We had a big down day a week ago and then a big up day on Friday. This was still continuing to decline. We're wondering, is this confirming the uptrend that we've been seeing? Looking on a momentum basis, we're still positive with the PMO. We're also above the midpoint based on price and volume. And our PMO studies, we're getting extreme with the PMOs that are rising. We're also extreme with the buy signals. We're still positive with the PMOs that are above zero. The Elder's Impulse system for the S&P remains positive with a green bar. The parabolic SAR is also positive. The slope oscillator, and you can see where it's getting up to a point where sometimes we topped out and started to go down. Not saying that's what will happen. We just want to be aware of this. But the MACD, which is an intermediate term oscillator, this is showing more improvement and turning more positive. So we are looking a little extreme with the slope. The TSI, another short-term oscillator, that's looking positive. Our intermediate term oscillators are still positive, and we're starting to cross above the midpoint here with our longer term oscillators. The Sean trend meter is showing some improvement. We're not quite up above this red line, which would suggest that we're starting to get extreme positive. We're above all of the plotted moving averages in our moving average tree, and that's a good thing if you're positive on the market. We're still climbing up with the bullish percent index for the S&P, and that is positive and suggesting there's internal strength inside the S&P. We're also showing an improvement with the NYSE bullish percent index, but here with the NASDAQ 100 bullish percent index, we're starting to get extreme positive. Doesn't mean we have to stop here. It just means that we might see some kind of exhaustion at some point. The Chaikin oscillator actually ticked down just a little bit, but it's still above zero, so that's positive. The ultimate oscillator also ticked down, but it's still above 50. That is positive. The money flow is starting to give us an extreme positive reading. Again, we don't get very many signals from this. We just want to be aware of this. And this is another one with the vortex. You see the green line is just shooting up. It's higher than we've been over the last year. this green line might be starting to get extreme positive. The RSI based on 14 periods is not extreme yet, and it's still positive, but we are extreme with the RSI 9. On-balance volume continues to be above an advancing moving average, and we're improving with the 200-day moving average study as well as the 50-period moving average study. The Copic curve continues to be positive, and you can also make a case maybe we're starting to get a little extreme with this indicator. The Pring bottom fisher, which didn't really give us a strong signal, it seems like it was at least a legitimate signal. That's continuing to suggest that things are positive. And then I don't have any Fibonacci charts, at least right here, because we're in no man's land with those. But looking at the Ichimoku cloud, we're breaking out above this red cloud, which had been acting as resistance. And we're well above all the trend lines here with our longer term chart here, our trend line study. And so far, this is holding up. Our different charts, the Heiken Ashi remains positive. The Kegi is still positive, the Renko is positive, and the 3-line break is positive. Our longer-term charts, the special K is starting to cross back above the red line. That could be longer-term positive. If this can hang on here and keep going up, this would be a very short-term sell signal. And then if we turn back and go above it, this could be a very positive thing longer term. We don't get a lot of signals with this particular indicator. Looking at our longer term moving averages, we're still showing some improvement with the 150 and 200 period moving average study. And then this is the soft landing when we're going up and we're seeing this continue to go higher. And then longer term with our weekly chart of the arithmetic scale, we're just continuing to go up above the trend line going back to 2009. Looking at some other indexes, the equal weight is showing some improvement, but it's still underperforming the S&P weighted index. And the ratio is coming down. Now, you could take this as negative. Oh my gosh, the mega caps, they're falling apart. This suggests that compared to the rest of the market, the broad market's doing better, which could end up being more positive for the market. So just because this ratio starts coming down does not necessarily mean it's negative. And looking at the discretionary equal weight ETF, which is showing some improvement here, but still in a longer term downtrend. The staples are also showing some improvement, but when we look at the ratio between the two, discretionary is looking better with outperforming staples. Looking at Dow theory, we were up with the Dow, the transports, the utilities ticked down slightly. The transports, even though they are improving, are continuing to underperform the Dow. But we're still going down with our Dow to transports ratio. When this is going down, that means the transports are outperforming. That's what we want to see in a positive environment. We want to see this going up if you're more negative on the market. And then looking at the ratio between the S&P and transports, this is starting to go back up, which could be positive for the market. The Dow is still above its 50 and 200-day moving averages. It may be escaping this death cross here. We closed right at this R2 level with the Dow, but the diamonds still remain positive for the Elders Impulse system. We came right up to this R2 level with the NASDAQ. That acted as overhead resistance, and then we closed down well off of the high. And we're still above the 61.8% retracement level for the NASDAQ. If we continue to fall, or if we start to fall, is this going to provide some kind of support? Looking at the NASDAQ 100, also battling with this R2 overhead resistance and closed well off of that level. But we really broke to the upside. We're back to testing this previous all-time high here. We may have set it on an intraday basis, but it doesn't look like we did on a closing basis. But the Elders Impulse system for the Qs still remains positive with green bars. The momentum for the NASDAQ 100 is still positive. The small caps are actually breaking above their 200-day moving average. They've got a lot of repairing to do, but they closed well off of the high and down below their 200-day moving average. So when we look at the Russell 2000 small cap index, we're starting to get extreme with the RSI. We were there yesterday. We did break above the 200-day moving average only to come back down, but on a momentum basis, the MACD is still positive. And the Elders Impulse system for the small cap still remains positive, but here is the bar right about here where the laser pointer is. That's where we closed, and that's not really a good thing to close so far off of the high. We did see a bit of an improvement here with the small caps to S&P 500, but overall they continue to underperform. The mid caps also closed well off their high and just barely above their 200-day moving average. And the mid caps still remain positive with the Elders Impulse system. We're still above the 50 and 200-day moving averages, with the financial sector. That could be positive if we could get some legs and stay above this. It could turn it back to a golden cross. The microcaps, yes, they closed back above 100. That's the green line that we see right here. So they are showing some improvement. The FANG index, it was unchanged on the day, but overall it continues to show a pretty healthy chart pattern. We're above the 50-day moving average and we're in a longer-term uptrend. And we're wondering, are we going to come back and retest this previous all-time high? We broke above this green trend line. I drew this red line here just to kind of mark where the previous high was located. And then we look at the tech sector and compare it with 3 to 7 year bonds. This is continuing to go up. That's positive for tech. The broad market is also showing an improvement compared to 3 to 7 year bonds. That's showing broader based improvement. And the S&P 1500, which is a broader base index that we follow, it's starting to break out when we compare it to shorter term bonds. So this is also showing some improvement and more of a broad based participation. Home construction, which I showed yesterday, it's continuing to show a little bit of an improvement here where it's breaking out above the rainbow. And the Eurozone, haven't showed that. We keep a close eye on the Eurozone. Particularly, we watch Germany because they have the biggest stock market in the EU. This is showing some improvement, and we're starting to break out above the rainbow when we compare it to the 3 to 7 year Treasury bond ETF. The dollar was up. It was really down on Tuesday. Well, it bounced back up a little bit in Wednesday's session. Keeping an eye on bonds, we were up with interest rates here. So when we look at price, we did gap a little bit lower. We're still in a downtrend based on price with a death cross. We're still above 50, but declining with the RSI. However, the momentum is still positive. And then our possible positive scenarios. We're above the moving average with the Qs to the S&P, showing some improvement with discretionary to S&P, and that's positive for the market. Discretionary had been one of the stronger areas until we hit the summer months, and then they started to show some weakness. Are they starting to make a comeback now? And we actually turned down a little bit when you compare large cap growth to large cap value, but we're still above the moving average. When we look at our growth to value ratios, we're flattening out to slightly declining with the large caps. We're showing some improvement with the mid caps and actually some weakness with the small caps. The S&P to utilities ratio is now starting to go back up. That could be positive for the S&P. The 10-day average of the S&P highs minus the lows are starting to get more positive here. If we go above this 90 level, that could be an extreme positive reading, something to watch for. But we're still negative when we look at the highs minus the lows and take a 5-period moving average across the broad market. We're still negative here, even though we're showing some improvement. We're showing some improvement with our 50-period new highs, new lows study, but it's still below zero because we really saw a breakout here with the black line, which is the indicator, and that's turning the red line back up. The 2-year Treasury yield, is this really topped out and starting to come back down? That could give some short to intermediate term support to the S&P. And then the Staples to S&P 500 ratio is continuing to decline. If you look at other times when that happened, that often meant the S&P was able to go higher. And then looking at the 19-day exponential moving average of the advanced decline ratio, we're above zero based on price and volume. And here's the 10 to the 5 yield curve where it's gone back to being more normal, just barely. And here's a chart from the other day. Okay, I'm still in the process of flipping these things over here, so I'm sorry about that, folks. For the month of November, it tends to be the best month of the year. Here's the Tom Bowley research. We're coming into the middle part of the month now where typically we might see some pullbacks. So what's our outlook for Thursday? Still dealing with earnings, still wondering about what's happening in Israel as it possibly concerns Iran, and then any more bombing that the U.S. may do in Syria. The technicals are still positive, but we are overbought. We will get the weekly jobless claims, import and export prices, the Philadelphia Fed Index, industrial production and capacity utilization, which in my opinion is probably the most important one of all the reports. And we'll get the NAHB Housing Market Index. And then we're keeping an eye on all the different geopolitical events. Here's the economic calendar showing that on Friday, we will get housing starts and building permits. The Stock Traders Almanac statistics. We are in the week of options expiration, where we're up about 60% of the time, down 40% of the time. For November 16th, we're neutral to positive across the board with all 3 indexes. We will be on the 12th trading day of the month, where sometimes we do see some weakness during a pre-election year. But overall, we tend to see a good seasonal time in the month of November. We also see positive seasonality here. And here's another chart going back to 1950 showing overall positive seasonality. But when you look at the Stock Traders Almanac chart, there are times in November when we do see some weakness before we see strength at the end of the month. And we see pretty much that same thing if we look at the green line, which is the S&P 500. This is a pre-election year after we had a bear market the previous year, which is what happened. And then keeping an eye on Bitcoin, I'm probably going to drop this in the next day or so. It's kind of losing its luster, but it's seeing a bit of a bounce up here. We're getting up into the 37 range, where after it topped out at 38, but it hasn't quite gone in and set a new high yet. So our scenarios, we're not going with the down scenario right now, although we are overbought, but our charts are positive. So if anything, we're going with that, even though we are extended to the upside and we may see some more exhaustion, if not a pullback. And we're not going with the sideways scenario right now because our ADX suggests that we are in a strengthening trending environment. So the warning signs, the longer term equity put call ratio is going up, the risk on posture, it's been showing some improvements lately, but still longer term, it's still going down. Our 50 period new highs, new lows study is negative, but it is trying to inch back up to that zero line. The Russell, the small caps and the mid caps are working off of recent death crosses. The financial sector is above both the 50 and 200-day moving average, but can it stay above that and possibly generate a golden cross? And then the positive signs. This is a new one. The daily special K chart has crossed back over positive. We'll see if the market's able to hang on to that, where the weekly chart is still negative. On a momentum basis, the S&P and NASDAQ are positive. The 5-period equity put call ratio, this is another new addition. It's finally starting to come down. The parabolic SAR as well as the vortex indicator is positive, but the vortex might be getting a little extreme with that green line. The bullish percent index is above 50 and positive. That suggests a more healthy environment. Small and mid cap growth, even though they've been chopping sideways and fell a little bit in Wednesday's session, they're still positive. So our conclusion, we're positive, but we're dealing with an overbought condition. In the short term and in the intermediate term, we can say the same thing, positive, but overbought. We are still positive in the long term because we're getting further away from the 200-day simple moving average. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.